Let me tell you what trading actually looks like for most people. They open an account with $5,000. They make $800 in the first 2 weeks and feel like a genius. They double their position size. They have a bad week, lose $1,400, and panic. They revenge trade to get it back. They lose another $1,800. They deposit more money, and 6 months later, they're sitting on a decimated account wondering what happened because nobody told them the truth before they started. That is not a rare story. That is the most common story in retail trading. And the reason it keeps happening over and over again is because most people enter the markets without understanding what trading actually is. Not what it looks like on YouTube, not what the highlights reel shows, but what it actually is when you're sitting at your desk on a Thursday afternoon and everything is going against you. Today, we're going to talk about that reality. We're going to talk about why traders go broke, how discipline is the only edge that survives long term, and what separates the small percentage of traders who build consistent results from the overwhelming majority who blow up their accounts and walk away. This is not a hype video. This is a survival guide. The real statistics, what the market doesn't advertise. Let's start with the numbers, because the numbers don't lie, even when the marketing does. Depending on the study you look at, and there are several credible ones covering Forex, futures, and equities, somewhere between 70% and 85% of retail traders lose money over any given year. Some studies put it even higher for specific instruments like leverage, Forex, and options. Let me say that again. 7 out of 10, 8 out of 10 losing. And it's not because those people are unintelligent. It's not because they didn't work hard or didn't study. A lot of them studied intensely. They bought courses, they read books, they watched hundreds of hours of content. The failure comes from something else entirely. It comes from the gap between understanding trading intellectually and executing trading emotionally. That gap is where accounts go to die. Here's what the profitable minority looks like. They're not necessarily smarter. They don't have some secret indicator that regular people can't access. What they have is a set of behaviors. Disciplined, consistent, unemotional behaviors that they execute over and over again, regardless of how any individual trade feels. That's it. That's the whole secret. And it sounds simple, but it is one of the hardest things a human being can do with money on the line. Because money isn't abstract. When you see your account drop $500 in 20 minutes, your brain doesn't process that as a number. It processes it as a threat. And your threat response, the same wiring that kept your ancestors alive, is catastrophically bad at managing a trading account. The 3 ways traders go broke. In my experience, there are 3 primary ways traders destroy their accounts. Not 1, not 10, 3. And almost every trading horror story traces back to one of these 3. The first is over-leveraging. Leverage is the most seductive and most dangerous tool in trading. It allows you to control a large position with a small amount of capital. A 10-to-1 leverage ratio means a 1% move in the underlying asset moves your account by 10%. That sounds great when you're right. It's catastrophic when you're wrong. Most new traders use leverage to amplify gains without fully internalizing that it amplifies losses with exactly the same force. A trade that should have cost them $200 costs them $2,000. And when that happens twice in a row, the account is in critical condition. The rule is simple. Use the minimum leverage necessary, not the maximum leverage available. Just because your broker offers 50-to-1 doesn't mean 50-to-1 is a tool you should ever touch. The second is the absence of a stop loss. A stop loss is not optional. I'll say that again. A stop loss is not optional. It is the single most important mechanical protection in your entire trading operation. Without a stop loss, a bad trade has no floor. It can go against you 5%, 10%, 20%, 40%. And if you're holding on, hoping, telling yourself it'll come back, your account is hemorrhaging while you wait. I have seen traders hold a losing position for weeks because they refused to take the loss. By the time they finally closed it, the damage was terminal. A stop loss forces you to define your maximum acceptable loss before your emotions are involved. That's the only time you can make that decision clearly. The third is revenge trading. You lose a trade, your brain immediately wants to make it back, so you jump into another trade, poorly planned, oversized, rushed, trying to recover what you lost, you lose again, now you're down double, and the cycle accelerates. Revenge trading is the most emotionally understandable and financially destructive behavior in the entire trading world. It is almost universally present in blown accounts. The cure for revenge trading is a rule, a written, pre-committed rule that says after a loss of X dollars or X percent, trading is done for the day. No exceptions, no negotiation, done. We'll talk more about building those rules in a few minutes. Position sizing, the skill that keeps you alive. If there is one skill that separates traders who survive from traders who don't, it's position sizing, not chart reading, not indicator selection, not news analysis, position sizing. Here's the concept. On any given trade, you should only risk a small, predetermined percentage of your total trading capital. The standard in professional trading is 1% to 2% per trade. Some very disciplined traders go as low as 0.5%. What that means practically, if you have a $10,000 account and you risk 1% per trade, your maximum loss on any single trade is $100. Now, I know what you're thinking. Brian, $100? That's nothing. How do I grow an account risking $100 a trade? Here's the answer. Consistency and time. A trader who risks 1% per trade and executes with 55% win rate over hundreds of trades grows their account steadily and survives the inevitable drawdown periods. A trader who risks 10% per trade and runs a hot streak looks like a hero, until 3 losing trades in a row wipe out 30% of their capital, and suddenly recovery requires a 43% gain just to get back to even. The math of drawdowns is brutal and asymmetric. A 25% drawdown requires a 33% gain to recover. A 50% drawdown requires a 100% gain. A 75% drawdown, you need to quadruple your remaining capital just to get back to where you started. Position sizing is about staying in the game long enough for your edge to play out. No edge works if you're bankrupt. Think about it like a professional poker player. The best poker players in the world don't go all in every hand, even when they think they have the best cards. They manage their stack. They play for the long session, not the single pot. Trading is the same game with different cards. The trading plan, your constitution. Every trader who survives long-term has a trading plan. Not in their head, on paper, written down, specific, detailed, reviewed before every trading session, and every trader who blows up their account was either operating without one or abandoned theirs the moment things got emotional. Your trading plan is your constitution. It's the document that governs your behavior when your emotions want to take over. Because when you're in a trade and it's going against you, you will not make good decisions based on feelings. Your plan makes the decisions. You just execute it. So, what goes in a trading plan? Let me give you the core components. Entry criteria. What specific conditions must exist before you enter a trade? Not, it looks like it might go up. Specific, quantifiable. Repeatable conditions. Exit criteria. Where is your stop loss? Where is your profit target? Both must be defined before you enter, not after. Before. Risk parameters. What percentage of your account are you risking per trade? What is your maximum daily loss? If you hit your daily max, what happens? The answer is you stop trading for the day, period. Position sizing rules. How do you calculate your position size based on your stop distance and risk percentage? This should be a formula you run every single time before you size into a position. Trading hours. When do you trade? When do you not trade? Markets behave differently at different times of day. Know when your setup performs best and restrict yourself to those windows. Review process. How often do you review your trades? What do you log? What are you looking for in your own performance data? This isn't bureaucracy. This is protection. The traders who skip the plan are the ones who email their broker in month 4 wondering why their account is gone. The psychology of discipline. Why your brain is your biggest enemy. Let's talk about what's happening inside your head when you trade, because understanding this might be the most valuable section of this entire video. Trading activates 2 of the most powerful cognitive biases that human beings carry. The first is loss aversion. Psychological research, and Nobel Prize-winning research at that, has shown that humans feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equivalent gain. Losing $100 feels worse than winning $100 feels good. In trading, this means your brain is wired to hold losing trades too long because closing the trade makes the loss real, and your brain desperately wants to avoid that reality. It tells you, just wait, it'll come back. Sometimes it does. More often, the loss compounds. The second is overconfidence bias. After a string of winning trades, the brain starts to believe it has figured out the market. It starts taking bigger risks. abandoning rules, feeling invincible. This is almost always the setup for a devastating loss. The market has a remarkable ability to humble exactly the traders who need it most, at exactly the worst moment. So how do you fight cognitive biases that are literally built into your neurology? You fight them with systems and rules that remove discretion, not willpower. Systems. Willpower is finite. You can't willpower your way through a bad trading day when you're exhausted, stressed, and watching your account move against you. But a rule that says stop loss is set and will not be moved, that rule holds when willpower wouldn't. You also fight them with a trading journal, not optional, every trade logged, entry, exit, reasoning, emotional state, result. When you review that journal weekly, patterns emerge. You'll see that your worst trades happen after your best days. You'll see that you consistently overtrade on Monday mornings or make bad decisions in the last hour of the session. That data is gold. It's self-knowledge that no course can give you. The most disciplined traders aren't emotionless. They're deeply aware of their emotions and have built structures that prevent those emotions from reaching the order button. The daily habits of traders who don't go broke. Let me tell you what the daily routine of a disciplined, surviving trader actually looks like, because it's probably not what you imagine. They start before the market opens. They review their watch list. They check the economic calendar for high-impact news events. They know exactly which setups they're looking for and exactly what the conditions need to look like for those setups to be valid. They are not reactive. They are prepared. They set their maximum daily loss number before the session begins. Today, I am willing to lose X dollars and not $1 more. If that number is hit, the platform closes and the day is done. This decision is made before any emotional investment in the session. They trade their plan. Not the news, not someone's tweet, not a tip from a trading group, their plan. After the session, they log every trade, not just the result, the process. Did they follow their rules? Were they patient? Did they force trades that weren't there? Were their entries and exits executed cleanly? And critically, they take breaks. They step away from the screen. They have a life outside of charts. The traders who are glued to their screens 12 hours a day, obsessing over every tick, burning out their nervous systems, and making increasingly desperate decisions. Those are not the success stories. The traders who work specific focused hours, do their analysis with a clear head, execute disciplined trades, and then close the laptop. Those are the ones still in business in year 3 and year 5. Recovery and perspective are not luxuries. They are professional requirements. What to do right now, your starting point. All right, let's get practical, because if you're serious about this, here's exactly where to start. First, trade a demo account until you're profitable. Not a week, not a month necessarily, until you are actually profitable over a meaningful sample size of trades, at least 50 to 100 trades, with consistent execution of a defined system. The market will be there when you're ready. Don't rush real money into the seat before you've earned it. Second, write your trading plan before you ever place a live trade. Sit down this week. Entry criteria, exit criteria, risk per trade, daily loss limit, trading hours. Write it down, print it out, put it where you can see it. Third, commit to a risk amount per trade that would not hurt you to lose. If losing $50 on a trade is going to cause you emotional distress, you are trading too large for your account size or your current emotional capacity. Scale down until the loss of a single trade is genuinely manageable. Fourth, start a trade journal today. Every demo trade counts. Build the habit before it's real money on the line. Fifth, cut off the noise. The trading influencers with the Lamborghinis and the "I made $10,000 today" thumbnails are not your reference point. Your reference point is your own data, your own results, your own process. Protect that. And finally, be honest with yourself about whether trading is right for you at this stage of your financial life. Trading should be done with discretionary capital. Money you can afford to lose without derailing your life. If you're trading rent money, bill money, emergency fund money, stop. Get that foundation solid first. Then explore trading from a position of stability rather than desperation. Here's the truth that I want you to walk away with today. Trading is not a lottery. It is not a shortcut. It is not a get-rich-quick machine that the right YouTube video will unlock for you. It is a skill, a profession, one that takes time, self-knowledge, discipline, and a genuine tolerance for uncertainty. The people who succeed at it long-term are not lucky. They are prepared, they are process-driven, and they have made peace with the fact that losses are part of the business. Not failures to be avenged, but costs to be managed. Bankruptcy in trading doesn't come from bad luck. It comes from broken discipline, absent rules, and emotional decisions made in moments of stress. You now know the 3 ways traders go broke. You know why position sizing is the skill that keeps you alive. You know what a real trading plan looks like and why it's non-negotiable. And you know what your brain is doing when it's trying to sabotage you. That knowledge is an edge. Use it. If this video hit different, if it gave you something real, hit the like button and share it with someone who's about to start trading, because this might be the video that saves their account before they've even opened one. Subscribe if you haven't yet. Every week we break down the financial realities that most people only learn the hard way. Drop a comment below. Where are you in your trading journey? Just starting? Already blown an account and rebuilding? I want to hear it, and I want to help. Stay disciplined. Stay in the game. See you in the next one.